Welcome back, Alpha Hunters. Hope everybody had a fantastic week. Hopefully, it was a lovely week for you. The markets are closed for the week of March the 15th. Halfway through March already. That's right, we got about 2.5 weeks left of Q1. So let's go ahead and talk about what went on this week. And for everybody that stops by the live stream and appreciates the content, and definitely appreciate the feedback. Had a nice little gap down to start the week on Monday. A little bit of a gap down, tried lower, and then just kind of grinded back up to really basically the daily high. Not too indifferent there on the close. Wasn't dramatic or anything like that. Nice little gap up there on Tuesday. And then we saw a very strong pullback and then a very strong rip higher. Nice little pullback. And then, yeah, kind of bounced. Kind of ended at the daily highs, basically, essentially. Wednesday, pretty much a flat open a little bit there. And Wednesday was kind of a flat day for most of the day. You see a little bit of a higher open, but kind of just a sideways, a little bit of a higher push, and it just kind of rolled over there towards the end of the day, last 30 minutes. Nice little bounce off the kind of lows of the day. Thursday, nice little higher open, dropped very hard on the beginning part of the day there on Thursday, and then just kind of had a consolidated sell down, kind of compression feel to it, and then nice bounce and nice rollover, and then a very strong bounce there to finish the day. It was kind of a weird last 2 hours there, and then Friday we got the gap down, and kind of mentioned this on the live stream on Friday. When I got off the live stream on Thursday, it was about right here, a little bit after that point in time. We had this rollover. And if I would have been on a live stream, I would have mentioned, especially after seeing how strong we were to end the day on Thursday, said, "Hey, that's the line of the sand right there. Thursday's low. That is kind of gonna be it." But Friday comes, we actually gap below it, and then we kind of just retest right into that Thursday low, and then there you go. That was a great short opportunity, intraday traders, for you. So then a nice little bounce off the lows, kind of just hanging out. Ended kind of flat from where we opened for how we moved on the day there on Friday. But that's kind of how the week went. It was a volatile one. You can see we kind of have this huge kind of rounded top here as just kind of mound action. So will that spill over into next week as we get fed? The FOMC, everybody's favorite, because they never bring the volatility at all. So earlier this week, though, we did get Tuesday. We got CPI, and this came in a little hot, which was kind of peculiar why we did have a higher open there on Tuesday, but we did. We were a little bit higher on CPI. I think the more important one was really PPI. PPI Thursday morning also came in hot. The market was expecting 3.3%, and we got 0.6%, and we had a higher open again. It was very interesting. It's like, I thought the market's been expecting lower inflation, and then we get two higher inflations, and that's going also back over the past couple of weeks, and we've continued to see inflation data come in hot. So just kind of an interesting market reaction on both of those gap ups on Tuesday and Wednesday, but both of them got sold off there initially. Tuesday had a nicer bounce than Thursday. I think people stopped buying the bounce as much as we got later in the week. Retail sales also down a little bit, and then we got a consumer sentiment survey there on Friday. Basically flat in my opinion. But anyway, CPI year over year did come in at 3.2% compared to 3.1% for expected. So that's kind of what went on this week. You can see Friday, it's a pretty nasty gap down there, and I wouldn't be surprised if we do continue to see some selling early next week. Alrighty, take a look here at sector rotation for the week. That was real estate, the biggest underperformer. You see that really kind of dropped off there Thursday, Friday, but I was already having kind of a bad week there, especially second half of the day or towards the middle part of the day there on Tuesday. And then it just kind of carried into Wednesday, kind of rolled over there towards the end, Thursday. So, yeah, real estate, kind of a rough week. Discretionaries, tech also underperformed. Kind of makes sense. They typically will lead the market in any direction. Market didn't really have a great week towards the second half of the week. You got healthcare, utilities, communications also underperforming. Industrials kind of in line with the market there. Staples, financials outperforming. Materials did very well. Energies did very nicely. And this kind of goes back to there was a report that Ukrainian military made some strikes on Russian refineries, so that kind of sent commodity prices, oil, gas, heating oil higher. And there you go. If you want to know why, just go take a look at those commodities, and you would probably figure out the day that news came out. All right, take a look here at the VIX. Well, we have still this uptrending line. The last time we came down to it was on March the 1st. It was on Friday. The next week, opened higher and just kind of went higher. Kind of got close to it back down to that, uptrending line on Thursday. Got close to it and bounced. So kind of an interesting line for now. Continue to see if we continue to hold that line going forward into the future, because if we continue to see periods of rising volatility, that'll be interesting for the stock market going forward sometime, eventually. The DXY, the dollar index. All right. Thursday, very nice strong bounce. Obviously, too much inflation data has come in, I guess, over the past couple of weeks. It finally bounced. We saw a solid bounce. Kind of mentioned earlier this week as we kind of got this a little bit of a bounce, but a wick up into these moving averages, or the 10 at least coming down. It could possibly roll over there. I kind of wanted to see a little bit more of a consolidation before I kind of wanted to make a case for either direction. But yeah, I mean, Thursday, there you go, solid pushback higher, starting to make its way through the moving averages. It's not really clearly perfectly bullish. It's kind of a tough one because we got this lower wick that we did put in back on February 22nd, kind of at that same level. Got this whole consolidation zone, it's kind of at the same level. So if we do want to push an up out of here, I would say any kind of pullback into the moving averages at that point in time, I would be willing to more take that. Other than that, for now, I would kind of, it's not a bad bearish play. I'm not going to say it's not, because we did have a strong breakdown. We did break the lower ends of this kind of consolidation range back from late January. So I could make a case for probably being a little bit more bearish here, looking for the rollover than anything else. But if we pump higher, I think we'll see just dip buyers kind of come in here on the DXY and dollar. All right, taking a look at the GLD, or the Gold Trust. Well, this week was kind of a quiet week, especially compared to the two previous weeks. Nice, a little bit of a pullback consolidation. Nice little flag pattern kind of coming in here. I mean, we might consolidate here because we already are, and the 10 EMA might even continue to come up and support that and push higher. I would just continue to be bullish on gold on any kind of pullbacks. I've been saying that for a few months now, going all the way back to basically October when we had this massive run. I wanted to see more of a pullback, but things that happened in the Middle East basically got gold to then run, and it's been a dip buyer's market on gold ever since. I would continue to be a dip buyer on gold, any opportunities. Okay, I wouldn't be leveraged, like super leveraged on any dip opportunities, but I'll just be bullish on gold. We're breaking out all-time highs and stuff like that, even though we just pulled back over this past week. 10-year yields. Let's talk about yields here, man. I love talking yields because this is what is really going to determine the market's fate. And this and unemployment. I'm not going to really talk about unemployment in this video, but I will briefly a little bit later. 10-year yields, man. Yields pumped higher every day this week. Look at this. Maybe not pump higher on Monday, but Tuesday, nice strong pump. Wednesday, got through the moving averages. Thursday, as we continue to get inflation data, right? Tuesday, we got the CPI, moved higher. Thursday, we got PPI. Look at that move higher. So, anybody saying, oh, yeah, you know what? Yields are going lower. What yields are they looking at? Because I'm not seeing that. Here's a look at the 30-year. Obviously, we've made these higher lows. Trend line has connected in. So this trend line of these higher lows is going to be pretty important as we go forward as well. It's going to be a nice support one. But 10-year yield looking pretty good. And I'm not going to say that we're just going to pop up to 4.5 over the next week or two, or even by the end of the March. But for how strong they were this week, that looks pretty good. Let's take a look at the weekly real quick. Yeah, I mean, look at that weekly. If you were going to trade a stock, okay, and you see a weekly candle come in that looks like that, that looks very good. That looks very strong. So, I know it's yields. It's not the same thing as stocks or bonds, but kind of is the same thing as bonds a little bit, right? But yields, continue to pay attention to them, man. They have already bottomed. They bottomed back in late December, and they've been on an uptrend. While the markets continue to go higher throughout this year, I think might not be a bad time to take them gains, man. Take them gains. 10-2 inversion. I think this is a basing. I think we are in a basing area. Yeah, I mean that's about it. I think we're just in it. We've kind of been in the zone here for a while. We've stopped making really basically lower lows. We had a little bit of a lower low there on March 7th, but basically we've just been in that, I guess, negative 4.5 level. Kind of looking on the right side of there, about negative 4.5 or 0.45. I'm sorry, not 4.5, but 0.45. I mean, that's kind of been the base spot. So until we kind of break that down, I think that'll be the base, and then we might look for the push higher. Maybe as we go into the end of March, April, probably to me be a little bit more realistic. We might start curling up at the end of March, but yeah, just we'll have to see. But at least for now, it's in a basing area. HYG, the high yield corporate bonds. Well, yeah, we got these two upper wicks above basically this line. It's a zone. So it didn't hold. It came back down pretty hard there on Thursday. Friday, it's really trying to hold this 50 EMA as it's been coming up. So if we break that 50 EMA or Friday's low early next week, we might see the HYG continue to roll lower. Take a look at the LQD. Well, the LQD kind of came up into these lows, kind of this choppy area. That's kind of where it got to late last week, early this week, and just rolled over. Especially with that breakdown on Thursday, getting back below the moving averages. Doesn't look good. Doesn't look good because it kind of just looks like we broke down. We kind of just slowly retested up into these lows, kind of consolidation areas, and then we just rolled over. So that's basically what it looks like. Take a look at the TLT. Well, we got these downtrending highs. Kind of looks like the inverse of the 30-year yield, which it kind of should because it's meant to mimic like the 20-year plus Treasury bond ETF, right? It looks pretty bad, and it looks like we're going to continue to go down. And the real issue with the way some of these patterns look like this is they'll do this and they'll look like they're going to bounce. Eventually, what will wind up happening is they will just have a period of just constant of a constant move. And in this case, in the TLT's case, probably just bearish. It'll just be bearish, 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 bearish. You know, if you're looking at the 30-year yield, it would, people are looking for the rollover, but you keep getting the support, it keeps going higher, and it just be a constant, just keeps pushing higher, keeps pushing higher, keeps pushing higher. So it's going to be an interesting situation, especially with the yields. And what is something that could spur all of that movement, especially in the bonds or yield side of the market? Well, if yields go higher, I mean, that's going to put a lot of pressure on stocks. But what could push yields higher, to me, is unemployment. And I've mentioned this on some live streams. I haven't really made a video about this. I'm going to talk about it briefly here, but I might full on make a video about this because this is probably the area where we're going to see the unemployment. Okay, there are a lot of jobs out there built around software development, coding, software engineering, and this headline is one that you've seen from other people. Some people are coders, and they say AI is a direct threat to their job. Even the CEO of NVIDIA has said that do not learn coding because AI is going to do it better than you. So this headline from InfoWorld basically says new AI assistant threatens software engineering jobs. Devin, which I'm assuming is the AI, has the ability to actively collaborate with users during software development. This includes providing real-time progress updates, accepting feedback, and working together to make design choices. Yeah, that's not even just coding. I mean, think about all the people in the middle in the collaborative type process that are also kind of potentially getting threatened by AI. So if we start to see layoffs in that come from the AI area where AI is going to disrupt, the coding side, that is what would push unemployment higher. And if that does happen, I don't think the market, or I don't think the yield, the bonds, and the debt markets are going to really like the fact that the debt to GDP in U.S. is so high, and I think that'll push yields higher. So, all right, let's take a look around the market real quick. These 5 ETF overviews here. Yeah, I mean, we got this nice run here. I've been very glad. I mean, we've seen the RSP kind of push higher compared to the consolidation a lot of it had, But this move that we've had bullish really since the beginning of February, we got this double top that has come in here over the past 2 weeks. And we had a pretty solid breakdown going into the gap down on Friday. We had that retest higher into that neckline, kind of that double top. It's going to be pretty interesting to see what happens. I could understand taking that double top retest, that breakdown that we had Thursday, Friday, retest into that level. I can understand taking that bearish. I absolutely could. So that's all I'll say. But for everybody over the past year and a half that's been saying, the 90% of stocks out there, or the 95% of stocks out there, they're priced correctly, but we want participation to broaden out. Well, we've seen the broaden out here in 2024, especially here over the past few weeks, or the past month even. And why weren't they saying to buy those stocks? Why weren't they saying those stocks are great deals right now? Because they're not. If they were, people would have been saying, "Oh yeah, you should diversify." There are stocks in certain sectors that are probably good. They're probably the one or two, but it's not broad. It's not everything, and that's what the difference between the equal weight and the SPY will tell you what is working and what isn't. And right now, what's been working recently is kind of everything, and that's kind of the scary part. The Dow Jones Industrial Average. Whew, this thing is getting real tied up in here. I mean, we're getting nice little horizontal compression kind of going on here over the past 4 weeks, 3-4 weeks. Yeah, it's looking pretty good. You could even trade what the horizontal lines I basically just put on the chart here. So the highs that we've had over the past couple of weeks and the lows over the past couple of weeks, and there you go. There you go. I mean, that's not really much else to say. Getting through these moving averages, the 10 and the 20, especially with that gap down and holding below it. It's going to be very important to see what we do on Monday, but we might have a little additional 3-point sell-off, maybe down to the 50 EMA here, coming pretty soon here on the DIA. The IWM Russell 2000 ETF. Well, I think we got this false breakout. Last Friday, we kind of talked about that. This huge sell down candle that we got, and then we've continued lower. It doesn't look good, man. It just doesn't, man. We got below these 10 and 20 moving averages. We held below it 2 days in a row. We even kind of retested that 20 moving average on Friday. I mean, maybe 2.5 points lower back down to the 200 level or the 199 level where the 50 EMA is. Makes sense. You also kind of got what's like a little bit of shoulder, head, neckline, double neckline, shoulder, and you got a breakdown. You got the retest. So if we continue lower, I mean, that's exactly what that looks like. That looks kind of brutal. So there you go. That's a little bit of a head and shoulders action there on the IWM. All right, and the Qs. So I mean, we were kind of talking about the broadening out here recently for the RSP. That kind of just tells you a lot of the stocks in the SP 500, how the majority of stocks are doing. And the majority of stocks have been doing pretty good. They've been running up, especially since the beginning of February. Oh, the Qs haven't. Like, they've been kind of stagnant. They've been looking like they were going to break down. They looked like they were going to push higher last Friday, but they got sold off pretty aggressively. They ended basically on the lows of the week on Friday. That doesn't look good. And if we take a look at it weekly, I mean, yeah, it doesn't look good. It looks like we might pull back just a little bit more. Maybe we do that early on Monday, Tuesday, maybe another 3 points lower or so to the 10 EMA on a weekly. It doesn't look good. It looks like we're starting to kind of lose the luster. And I don't like, tech doesn't look good. It's priced very richly. And do you really want to own all the other stocks that don't have the growth potential? Not really. But those are the ones that have been performing here over the past month and a half. So the market to me is kind of in a weird spot, because if people were saying, oh yeah, you should start to own all the other stocks, well, they would have been saying that, and they weren't. But they were asking for the market rally to broaden out. But they were saying that everything else is priced fairly. So it's just interesting. They're asking for both things at the same time. I don't know. Interesting. SPY. So the SPY has actually been doing okay. So I mean, with the breakdown that we had of the support line here on this line, I would say we're probably due for a decent pullback, back to a previous all-time high type area. It's going to be a little bit over 5%, about 5.5%, 6%. So that makes sense. Kind of get down there, kind of mix it around. Maybe here over the next month. Makes sense. Yields probably push higher. People probably talk a lot about, yields, and then yields will probably rest, and then we'll rally. And at that point in time, we'll probably reassess. But that would be kind of what I'm thinking, what we're probably looking at in the future. I do expect once we kind of pull back to this 408, 409, 410 level, we will get some kind of bounce and maybe we'll roll over again. Probably is going to depend highly upon what unemployment and what yields are doing. And but for now, I would be a little bit more protective, especially seeing the Qs break down. The Qs are going to lead us because, I mean, there's too much weight in the Qs, especially in the concentration of big tech. If you think big tech is concentrated or has a huge weighting on the SPY, it has even more weighting on the Qs. That's why people focus on the Qs right now, because all that weighting from the things that have been working over the past several years just dominates it. So right now, I would still probably just be more protective on the SPY, even though it hasn't fully broken down here. I would be protective, even though we haven't broken this low. I think the Q's kind of showing its hand early, kind of gives you a little bit of an opportunity to probably say, okay, yeah, let's be a little bit protective for maybe about a 5 or 6, 7% lower. I guess from here, how far would it be down? About 6%. About 6%, not quite. And yeah, you just be protective, with your capital, and just understand that trends like this that we've had go on for the past 4.5 months don't last forever. This has been an historic one, and typically, I will say this, is whenever you get trend moves like this, they are at bottoms or they are at tops. They are not in the middle. So I couldn't imagine us being in the middle with where we were when we did this. So that's all I really got. Alpha hunters, have a great weekend. Take care, and we'll see what happens next week. FOMC day. Don't forget about it. It's gonna be so much fun. Alrighty, take care, Alpha hunters.